Tuesday, October 13th, 2020, Maneco 64, home of alternative economics and contrarian views. So I get the question a lot from the viewers, when will hyperinflation start? How come money velocity is still so low? And today I'm going to try to answer that question. I'm going to try to show you what the trigger for the start of the loss of confidence in the currency will be. Hyperinflation is the final step, I would say, in that loss of confidence. Before I do that, I like to touch upon a couple of subjects. First one is an article I wrote yesterday, and I posted it on my blog called maneco64.net. I'm going to put a link to that article below in the description. You can go and read it. And it's entitled Understanding Money. And it's a 1,200 word essay or article, if you want to call it, talking about the evolution of money, how it started out, and how the monetary system has been hijacked by the bankers and governments. It's not the last article on this subject. And the second point I wanted to make is that we saw news yesterday that the Bank of England have been writing to the UK banks, asking them how ready they are for negative interest rates. So you can bet that the money printing, the bond buying is not going to stop. The monetary inflation is not going to stop. So just wanted to put that out there. In the letter, the Bank of England said, this doesn't mean we're going to implement negative rates, but I think it's highly probable now, and it could be at their November meeting, their MPC meeting, they could also announce another 100 billion in QE, I think. So now to what I think is going to trigger the beginnings of the loss of confidence in the currency. And by that I mean the major reserve currency of the world, the dollar, and of course all the other currencies in the world, as we know, are linked to the dollar. So once there's loss of confidence or hyperinflation in the dollar, all the other currencies will also hyperinflate. There is no, how can I say, safe haven in the fiat currencies. As I've said, gold and silver are the only place to be when there is a hyperinflation. So I'm going to reference Ludwig von Mises' Human Action here, a treatise on economics. This is what the Wall Street Journal says about this book. Ought to be on the bookshelf of every thinking man. So von Mises talks about the flight to real goods, or the crack up boom. I'm not going to go through that, but I'm going to go through what he says here about the first stage. It says, this first stage of the inflationary process may last for many years. So that's what we've been having. While it lasts, the prices of many goods and services are not yet adjusted to the altered money relation. There are still people in the country who have not yet become aware of the fact that they're confronted with a price revolution, which will finally result in a considerable rise of all prices. Although the extent of this rise will not be the same in the various commodities and services, these people still believe that prices one day will drop. Waiting for this day, they restrict their purchases and concomitantly increase their cash holdings. So I think this is what's happening at the moment. People still believe prices will come down. Maybe not you or me, but a lot of people still do. And that's why they're hoarding cash. And that's why money velocity is still very low. As long as such ideas are still held by public opinion, it is not yet too late for the government to abandon its inflationary policy. So I guess they could stop the QE, the zero or negative interest rates, which you are seeing now the Bank of England indicate that they're going to have. But do you really think they're going to stop this inflationary policy? It doesn't look like it. And here's the interesting part. But then finally the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. A breakdown occurs. The crack up boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, the things which were used as money are no longer used as media of exchange. They become scrap paper or scrap digital entries, if you want to call it, nowadays as well. Nobody wants to give away anything against them. It was this that happened with the continental currency in America in 1781, with the French mandat territoriaux in 1796, and with the German mark in 1923. It will happen again whenever the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. So there you go. That's why money velocity is still low, because a lot of people still believe in what they've been told, that the danger that we have is low inflation or deflation. So they're continuing to hoard a lot of cash. But I think when we start seeing commodities prices rise quite sharply, we're going to see this mindset change. We're going to see, I think, prices of paper assets drop. I know we're continuing to see a bubble in the stock markets, but I think that's all gonna turn, and a lot of money is gonna go into commodities. I think the price of gold and silver are pointing to that. Gold, of course, is a monetary commodity. Silver is a hybrid, monetary, but it's also an industrial metal. And I think they're giving us the signal that all the other commodities, like soft commodities, base metals, and others, are also going to follow suit. And this is what Incrementum has written about it in their report in Gold We Trust 2020. Where does the money flow to? It says it is very possible that experimental monetary policy will trigger a renaissance of hard assets. If that thesis is correct, the battered commodity sector should also offer opportunities to courageous contrarian investors. Relative to the Dow Jones Index, commodities are currently trading at the lowest valuation level since the mid-1960s. Compared to equities, commodities were undervalued to a similar extent only before Black Thursday on October 24th, 1929, and during the exaggerations of the dot-com bubble. So there you go. That's how undervalued commodities are. So I think we need to keep an eye on the general commodities markets. And for that, I think the Bloomberg Commodity Index here is a good one to keep an eye on. This is the 5-year chart. As you can see, we're still not anywhere near the 5-year highs, but it looks like we made the bottom earlier this year around March time, when everything crashed, of course. And I think the key level here is going to be if we can break the 73.50, 74 level in the Bloomberg Commodity Index. So that's when I think people, the general public, are going to start noticing that prices are rising, that we've had massive inflation. The central bankers up until now have been able to guide that monetary inflation towards paper assets, towards stocks and bonds. But once that monetary inflation starts flowing into hard assets, I think that's when people are going to wake up, and you're going to start to see an acceleration of that, acceleration of the drop in demand for cash. We're going to start seeing money velocity start moving higher, and we're going to be well on our way to a loss of confidence in the currency and hyperinflation. And when that happens, if you haven't prepared for it, if you haven't bought your fire insurance, so to speak, precious metals, you will never be able to get any protection, because loss of confidence and hyperinflation happens very quickly. It's not a linear event. It's a geometric event. It's better to be prepared for years than to not be prepared when it happens. So hopefully that answers people's questions. If you have more questions, of course, comment below in the comment section, or we can talk about it on Sunday during my weekly live stream at 9 p.m. London. So with that, let's look at where the markets are this morning. It's 10 past 9 a.m. London. So right now we've got gold trading around 1920. It's down just over $2. Range has been 1910 to 1930. Silver has come back below 25. It was doing quite well yesterday early on. And as usual, as the US came in, it dropped a little bit. Right now, we're just below 25 at 24.93. It's down about 16 cents. Range has been 24.58. High's been 25.21. So what about the stock market? The Dow future is down about 38 points, 28,800. Down about 1/8%. S&P likewise, it's at 35.29, down 4.5 points. The NASDAQ 100 future is up 20 points at 12,105. So we saw a big move yesterday in the tech stocks, of course. The currencies, we've got sterling down 0.25% at 130.30. We've got the euro down 0.2 at 117.87. Dollar is up slightly versus the yen at 105.44. WTI crude is up almost 1% at 39.93. The 10-year yields, to finish off, is down about 2 basis points at 0.75%. That's the 10-year yield. And in terms of the gilts, which is the equivalent to US Treasuries in the UK, we're seeing the yields up to almost 6 years of maturity for gilts negative. So the Bank of England is trying to push bond prices higher, especially the short-term bond prices, by telegraphing that they're going to bring in negative interest rates. That's the other thing, because negative interest rates means higher bond prices. So they're just telegraphing as well to speculators that they should buy bonds. And all that means is this inflationary policy is going to continue, not only from the Bank of England, but from the ECB, from the Federal Reserve. Recently, we saw, of course, some economists write from the Federal Reserve that the Fed should buy another $6 trillion in assets, in treasuries and also corporate bonds. So there you go. If you enjoyed this video, make sure you hit the like button, share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.